Good morning. How's everybody? Good, good. I enjoyed that discussion on Atlanta. I want to thank all the investment professionals here for inviting us here to speak to you today. My daughter just finished her sophomore year at Emory and has really enjoyed getting to know the city. And we have, as a family, the Center for Social Justice and Human Rights is an exceptional experience, and it really has done a lot to create a lot of good conversations in my family. So it's a great city and a city on the move, and we're glad to be here. So we've been asked to talk a little bit about the pension industry, and we just heard about how the city of Atlanta has made some reforms to its pension systems that allow them to free up capital to do other things and meet other needs across the city. You know, this is a trend and a discussion that's going on throughout the world. I think in the retirement industry, it's where I've spent my career. It's really the confluence of public policy, politics, huge sums of capital, and overall to ensure financial solvency for all of us. So it's important work, and all of us as investment professionals are sort of stewards that take that responsibility, pretty seriously. But let me start with sort of the micro. I have 3 daughters. My oldest daughter just graduated from college on Sunday from Steve Davenport's alma mater. She's got a job in Manhattan, starts in 3 or 4 weeks, and she called me last night and said, I got this apartment, Dad. I'm with 2 other people. It's somewhere on the Lower East Side, but it only costs $1,200 a month. Only $1,200 a month. She said a little bit more than $1,200, which really means $1,300 a month. And I'm thinking to myself, that's got to be well over half of her disposable income after her base salary. And how is she really going to make it in Manhattan, a pretty expensive city? And is this the right move for her, at this time? But the reality is that when you're young, your perspective is broader. You have plenty of time with which to create capital in your own life, and you're comfortable with not having a lot of money in your pocket when you're first starting out. I started thinking about my own experience. When I got out of college, I was a community organizer in Philadelphia. I made $400 a month. I was broke, but I was okay with it. I had enough money for beer to kick around and enough money maybe to see my girlfriend, now wife, in Baltimore. So it was okay from that kind of standpoint. But Tim Noonan, he's an advisor at Russell Investments, and he provides advice to other financial professionals. And he wrote a book called Someday Rich. And he makes the observation that aging, has a direct impact on the proportional value of time and money. That as you get older, the squeeze of time makes money and capital raising far more important to you. And this dynamic really grows and grows to the point where it almost can be fearful, to some. Even for people who are exceptionally wealthy, that fear is still paramount. John Rockefeller, in the twilight of his life, was asked, how much is enough? You know what he said? A little bit more. So, my point is that if you're young and broke, it's not a problem. If you're old and destitute, it's a big, big problem. So what are we doing as a community, as people, as a nation, as part of the global economy to ensure that as people reach that point in life where they're no longer working, can they have a successful retirement? Is there going to be enough money, there for them? And what's happening in the U.S.? What are we seeing? I was at a conference before I came to Atlanta, and one table is littered with pension risk transfer. So corporations are saying, I'm going to shift the liabilities of the plan from me to an insurance company for the benefit of my participants. That's a big trend that's going out there. The other obvious trend in the corporate world and in the public space is a shift from defined benefits to defined contribution, where the shift of investment responsibility moves from the plan sponsor, to the individual. So what do we have growing here, at least in the U.S.? You have a shift in liability to the individual. The individuals may not have the discipline or an investment acumen to really exercise a thoughtful growth of capital, and you have an aging population. Last week, the Government Office of Accounting released some results of a survey that they did, where they basically found that 60% of all American households do not have access, or rather, are not really investing in 401k plans. And 40% of those households of that universe don't have any access at all. So while we have this shift from plan sponsor to individual, we also don't have a lot of people participating in that. So where does this all lead us? Where is it all kind of going? The retirement policy is paramount to the global economy and the global discussion. There's huge amounts of capital that are being deployed. But are we embracing that, or are we kind of shrinking from that is sort of the open question that's out there. I'm not sure how to advance the slides here. Is there a... Oh, okay, great. Thank you. All right, this is some work that we did based on data from the United Nations. And when I first looked at this, I said, uh-oh, but I didn't say, oh, I said something else. Look at the gray areas. This is the baby boomers, Gen X, millennials, and Generation Y. Right now, across the global economy, we have more working people than people over the age of 64. And that's what this work is doing. Just looking at people over the age of 64 versus the working population. So we have the vast majority, right now, roughly 27% of the work are retired, and the other 74% are feeding that kind of retirement. But if we fast forward 25 years, that starts to grow to a mean of around 40%. And if we fast forward 60 years and 70 years, it gets even more pronounced. Suddenly, the number of people that are in the workforce is less than the number of people that are over the age of 64. And we're all familiar with how the age of people and the length of people living is growing as well. So this is a dynamic that, in the face of these dynamics of retirement and money and capital, that is going to grow a much more dynamic, much more dominant part of our conversation. I thought what we do is sort of take a quick look at certain countries. Who sort of got it right. Look at Norway. So obviously they have this growing amount of an aging population. But the Central Bank of Norway has a centralized pension system. It provides that kind of social safety net for the citizens of Norway. The pension plan is overfunded. It's considered one of the strongest and most well-run pension systems in the world. It invests in a variety of different infrastructure, real estate, private equity. It's the dominant components of their overall investment portfolio. They have offices throughout the world where they're looking to apply this kind of capital to create alpha, but also to make an impact on society. This is an example of a country that seems to have it right when it comes to retirement policy. Now here's a dynamic in Singapore. This is the most pronounced trend where you have an aging population in the country of Singapore. This is a country that culturally wants to support its elders. So they're going to have quite a bit of work to do, and they're going to need to move very quickly given this kind of trend and dynamic. Now what about the U.S.? How do we look? You can see the baby boomers hitting in about 10 years, and that graph starts to get pretty steep and then starts to level off. But we have a different dynamic in the U.S. I talked about the shift of pension liabilities to the individual, and what's that going to mean, and do people really have access, to the right kinds of retirement plans with which to do that. So we have significantly underfunded pension systems in different states and different municipalities, and how are we going to address that over time? And we have a real need for education for individuals that are in these 401k plans so that they're creating capital long term. Consider the Central States Pension Plan. This is a multi-employer Taft-Hartley plan that a lot of companies contributed to for drivers and workers and members of the Teamsters. UPS was a big contributor to that particular plan. That plan is in sort of dire straits right now. And it's a tale for all of us, because it underscores the reality that social safety net that people are counting on may not be there. Now, the actuaries for the Central States Pension Plan released a report said it's going to be out of money in 10 years. And there's something like 400,000 beneficiaries of that particular plan. Recently, certain members and stakeholders of this plan appealed to the Treasury Department to create reform, create relief, change the liability patterns of the plan, and it was denied by the Treasury Department. And it was denied, maybe not so much for political reasons, but for reasons that the plan they didn't feel was sustainable, that despite the cuts in liabilities, it was still unsustainable because it was assuming a 7.5% return. And the Treasury Department said, you're never going to get there. And so practically, the Treasury Department is right. They need to come back with a better plan, but a better plan means reducing the amount of liabilities and taking more out of the pockets of the beneficiaries of the plan. So it's a difficult and compelling dynamic that's going out there today, and one that collectively we have to be focused on as a country and as a nation to kind of get our arms around that. So we conducted this survey. This is the second year that we've done this. We've polled about 400 COOs, CEOs, and executive directors of different retirement systems throughout the world, just to get a sense of what are their thoughts, where are they going, how are they managing this capital, where is it all going from their perspective. What we found is that pension systems are working to build stronger governance frameworks. They're looking to really accentuate the risk management capabilities of the plan, and they're looking for more talent within those retirement boards. There's a growing trend to insource certain components of the management of those assets, less reliance on third parties, building their own fund of hedge funds, creating their own teams of private equity analysts, insourcing active strategies. These are all things that we're seeing across this universe. Now, this is a pretty diverse group. It's well balanced across different types of institutions and also geographically, EMEA, Asia, North America, etc. So I think it's comprehensive, and I think we can rely on a lot of the findings in this particular report. So I thought what we do is sort of work toward some of those specific trends. One of the things that we found compelling was that 92% of the respondents were taking a look at how do I optimize my board. They seriously want to make changes with regard to the board structures. And board structures take on different components. If it's a corporation, it's a very small board. Maybe there's an investment committee, it's the CFO, it's the treasurer, etc. It's one of 100 things that they're focused on. In the public space, the boards are broader. It involves a variety of stakeholders, beneficiaries of the plan, members of the community, and creates a more diversified approach and perspective. So every board is a little bit different, but 92% is saying we need to get better in terms of the oversight. One of the things that was also very compelling was that only 32% felt that their board was strong at looking beyond the short-term issues, looking long-term, sort of getting back to the slides of an aging population. This is sort of their perspective and what they need to do. So while our survey didn't drill down deeper as to why, it does beg the question, why are CEOs and COOs are focusing on this in terms of governance? And I think it's a couple things. I think first it starts with the boards themselves. They embrace the fiduciary responsibility they have. They recognize the significance of their work and how a lot of people are counting on their good judgment. So they want to learn more. They want to expand their education. They want to develop their investment acumen from that perspective. I think that's one of the drivers. Another driver, I suspect, is the speed with which investment professionals have to work to get access to the best investment ideas. So if they're looking at a particular deal, if they're looking at a real estate investment, they're going to have some form of board oversight of whether they can move or not move on it, and they need to move quickly. If they don't move quickly, they lose out on the deal. So I expect those CIOs are looking for investment professionals on their board that could move just as quick as they can, to ask the right questions and allow them to move quickly and also, prevent themselves from making wrong decisions. But that kind of real-time component of investment is out there. And it's a big part of the trend that we're seeing across these different retirement systems in terms of access to real-time data, and real-time data with which to mitigate risks and understand what's going on in the overall portfolio construction. This is a real important driver that we're seeing out there. I look at some of the plans that are pretty successful at doing this. Like in North America, some of the larger Canadian pension plans, like the Ontario Teachers Plan and OMERS, and the Canadian Pension Plan, they're actually setting up investment offices globally and putting some of their investment professionals in London, in different parts of Europe, in Africa, and Asia, so they could be closer to the ground to understand where are those investment opportunities. The larger pension plans have insourced a lot of this analyst work, and a lot of their portfolio is going direct into real estate, private equity, things of that nature. If you fly to Toronto, there's buildings and cranes going up everywhere, and a lot of the capital for that building is coming from their centralized pension plans in that kind of regard. So this is part of the dynamic and the trend that's going out there, and I think why we're seeing these kinds of demands in terms of improved governance over the different plans. One of the other compelling and things that jumped out in our research was environmental social governance. This is an important component and a demand and discussion that's happening across different retirement boards and different retirement systems. 80% say they're more likely to hire a manager with ESG capabilities. So for those of you working in independent shops, this has got to be a component of what you're going to be offering. The ability to get access to data and apply, whether it's the screens or creating positive social investing and impact in the overall portfolio construction. There's been an evolution, progression in ESG. It started with a theme of exclusion. I'm going to put screens up, and I'm not going to invest in sin stocks and other kinds of things, and that's how I was going to embrace the ESG. But over time and over years, that isn't sufficient enough. It changed to a more proactive kind of investing. I want to make a social impact in what I'm investing in. Certain systems are allocating 4%, 5% of their overall allocation to ideas around creating a positive social impact or reinvesting in the communities that they live and work in, whether it's roads and infrastructure and other kinds of things. We're seeing that CalPERS does a significant amount of work in this kind of way. So this kind of social impact investing is part of where things are going. But it doesn't stop there. It's now moving into how do I properly measure and evaluate the return on these kinds of strategies? Is it generating the alpha that I need? Is it generating the right amount of returns? And then how do I take a look at all my positions, whether it's within a particular hedge fund or some sort of LP position, so that I can see and draw out that data to calculate a return on the overall portfolio construction for stocks that are creating that kind of social impact. So it's a big component. It's not only just the investing impact, but how we measure it and how it pervades the entire portfolio construction. I would say that this finding is also a reflection of the participants themselves and what they expect and what they want to see out of these huge sums of capital that are being deployed. It really is an amazing amount of capital and what you could do with it. The University of California Regent System, this is the pension system for all the universities and that are out there and their people. UCal Berkeley and Caltech have an enormous amount of patents that they developed at their schools and universities that they own. One of the things that the pension system is doing is taking a look at some of those patents, the best ideas, and helping capitalize those investment ideas for companies and allowing them to grow. An interesting way to take good thought and good ideas that they have and funding it with capital that's going to create the kind of returns necessary to support the retirees of that plan. So these are creative ways that are going on, across the industry and doing good while investing our capital. I think we also see that in the passive side. Our company has done a lot of work with other asset owners in terms of creating specialized indices that reinforce the ESG components and values of that particular organization. We work with the United Nations, and they funded the first low-carbon ETF out in the marketplace. Recently, 2 months ago, we developed an index that looked at gender diversity. What we found is that companies that are stronger in diversifying their boards and their management with women outperform other companies. This kind of dynamic and work with CalSTRS, Chris Ailman, the CIO of the California Teachers Association, was one of the initial funders. We created this passive indice. They became an investor in it, and we launched an ETF. It's called SHE, S-H-E is the symbol. But in any event, it's from Chris's perspective at CalSTRS, it's a great way for me to allocate to my equity index and my passive strategy at a lower risk. And that's how he sees it. It's about lowering risk and, to some respect, generating some alpha in these kinds of strategies. So you see this sort of integration that's happening in terms of indice, social governance, and investment product out in the marketplace today. One of the other findings is an increased appetite for investment risk. Pension plans are allocating more to alternatives, particularly private equity, real estate, infrastructure. Even with hedge funds and fund-to-fund programs, that allocation increases. Year to date, the amount of increase to hedge funds has gone up by 5%. Which is in contrast to some of the more notable news items where major pension systems are divesting from their hedge fund strategies. CalPERS is one noted one that's out there and doing that today. So globally, we're seeing more of this investment into alternatives. I guess what does that mean? What it means is that, do you know what's going on as an LP in some of those investments? Maybe you're going direct, or you're creating a hedge fund separate account platform where you get that kind of transparency. But what happens when you're an LP and that general partner doesn't necessarily want to see the secret sauce? What are CIOs and CIOs doing in that kind of regard? Well, part of it becomes a data strategy. And that's what's changing the overall global trust bank model here. Since the portfolio construction of pension plans is largely 40-50% in alternative investments, most of them LPs, a lot in CITs and other kinds of pooled investment structures. How does a CIO get to see what's going on underneath those particular assets? So our business is changing dramatically. It's not so much the long positions that are in the pension plan, it's these alternative investments. So part of what we're doing, it becomes a data play, and it becomes a data aggregation and data warehousing capabilities. How do we provide our clients transparency into those positions so they get a sense of the aggregate position across their total portfolio with cash flows so they can properly model on that and make prudent investment decisions? Where am I exposed? And do I have to put a hedge on that particular sector or that particular industry because I'm overweighted in one, because one LP is going in one direction, two LPs are going in the same direction, or things in that nature. So our work is fundamentally changing. While we're a global trust bank at State Street and a fiduciary, much of our work is around technology and data and aggregating that data in meaningful ways for what we're doing out there in the marketplace today. So another interesting finding, notwithstanding the investment into alternative investments, one of the other compelling findings we found was that no more than 20% of the retirement funds rate themselves as highly effective of managing key risk. So here you have this dynamic of moving into alternatives where you don't have access to the data and you don't feel like you're adequately managing the risk. So that's creating a dynamic in the financial services industries where companies like SS&C, SimCorp, BlackRock Aladdin System, TrueView, and other risk management portfolios and systems are really starting to drive the day and starting to grow in terms of providing that kind of transparency and giving CIOs the tools with which to make, good decisions. And I'll leave you with this final, observation that we're seeing out there in the community, and this is this continued trend toward insourcing asset management. And the majority of times, what's driving this is systems looking to reduce costs and reduce investment management fees in particular. And I'm sure everybody here feels that compression that's going on. And they're asking themselves whether I can run that kind of mandate internally myself at a lower cost by hiring investment professionals. That's just in equity and fixed income. Typically, we see it start in equity, fixed income, and cash is what they're insourcing. But we're also seeing in terms of them hiring their own alternative managers, their own analysts, creating their own fund of funds. Asset owners are saying, treat me like I'm one of your hedge fund managers. Give me the same kinds of tools and systems that a big hedge fund shop is utilizing from you. This has been a big shift in what pension funds are doing. And I don't see this trend toward insourcing abating in any event. The other component of this is like once they make a decision to insource this asset management, and this is underappreciated by the pension plans, is the amount of investment and operational risk that they now have. They own that operational risk, they own that market risk, they have to build that out, they have to build the controls, the segregation of duties. Are they going to buy portfolio management software and run it in-house? Are they going to outsource some of that kind of work to a third party? How are they going to approach that? Do they really appreciate the amount of time, effort, and risk management necessary to run an investment operation? The trend in the pension space is to insource these functions as well. They're using Yardi for their real estate. They're running Murex and SimCorp in-house. They bought Charles River and Aladdin as front ends, the typical tools that all of you are using to deploy investment advice from that perspective. So they are very much asset managers in that own right. This is most pronounced at the largest plans. If it's 50 billion in assets, they tend to insource. If it's 10 to 50, they're kind of on the fence. They might be insourcing asset strategy. Below 10 billion, you don't necessarily, see this kind of trend and what's going on in the marketplace today. So, fear not though. This survey also supports the fact that all retirement systems continue to want to lean on third-party advice, third-party managers, and third-party consultants that are out there. 78% of the respondents in North America said they see themselves continuing to use all the financial advice and acumen that's in this room today. So I'll pause there and open up to any questions. No questions? If you want to ask me about the global trust bank industry, what's going on, I'd be happy to answer any question whatsoever. Yes, sir. I think what keeps us up at night as a global SIFI is capital, the deployment of capital, how we use that capital, fair or unfair, these are the new rules. This is the new normal. I was looking at a conference next month that was out there. They talked about the new normal. It is very much the new normal that's out there. One of the ways that retirement systems pay for a lot of the services that are out there or create liquidity in their portfolios to the extent they're hedging different stocks is through securities lending. It's a big component of that. It generates huge amounts of revenue for the systems. But that market after post-crisis kind of stalled. The number of borrowers just wasn't there. It never really came back. Systems continue to want to lend out general collateral and kind of push it out from that standpoint to continue the flow of money that they needed. It didn't matter if they were only earning 2 basis points on the trade. They were comfortable with the risk and willing to put that out. Of course, banks that are facilitating the securities lending program are indemnifying the plan sponsor on both ends for the trade and for the collateral that we have. And pre-Dodd-Frank, banks, pre-Basel III, banks did not have to capitalize the value of that indemnification. And now they do. Now they do. And so that's going to change the way securities lending operates. It's going to change the kinds of splits that plan sponsors are going to get, and it's going to change the way collateral works. In the U.S., collateral is mostly cash and it's managed short term. In Europe, it's assets that are used as collateral, and that acts as a better risk mitigator. It doesn't require the same kind of capital. So things are changing, dramatically in this space. Net interest margins. Cover the Wall Street Journal today, 83 basis point spread between the 2-year Treasury and the 10-year Treasury. So all the banks are getting squeezed in that kind of regard. I had a conversation yesterday with a CIO of a client of ours in a pension plan, and he kind of half in jest, half serious. He's tired of paying 65 basis points for his cash in euros. He's got $50 to $100 million, and he wanted to know if I take that money and just put it in a bank, put it in a vault. I'll even pay you for the insurance and that sort of thing. It sure isn't going to be 65 basis points. So, all right, let me think about that. How am I going to do that? But so these are the things that worry me. It worries me about the aging population, how we're going to respond to it. And but I'm more optimistic than worried, candidly. Yes. One more question? You really want me to get off? Yeah. One more question. Yeah, I absolutely see that, and I see systems responding to that, and I see opportunities for companies that can provide that kind of advice and development, and I see board members using some of the certification programs in this community to kind of help them get there. Yeah. Well, thank you very much for your time. Enjoy the rest of the day.